Hey everybody, Ashley Page here. Thank you for joining us today on this special informational vlog we have for you on the use of Small Business Administration loans, or SBA for short. We wanted to offer this up to our owner-managed business clients and friends and anyone that we feel like could use the information on this. We're dividing sort of the video today in a couple of parts. The first part, we're going to talk to you to just some general anecdotal information on the playing field, as it were, for using SBA loans. That's first. And then the second part of the video is going to take a little bit more of a deep dive, not in all of the SBA loan types, but the primary loan types. One is the 7A loan, the other is the 504 that most owner businesses use. So first we'll start and say, well, why does a wealth firm like Five Plan Partners, why we're involved in this? From our beginning, we have to manage wealth holistically for our clients. And for many of our clients here at Five Plan, their wealth is not exclusively in markets. It's in owner-managed businesses. It's in timberland. It's in rental real estate. So if we're going to do this completely and correctly, we've got to have expertise within the firm to capture wealth creation for our clients and are not just in markets. And for us here at Five Plan, this is actually a big segment. And the reason for it is, if you're watching us, we're here in Birmingham and outside of the strong healthcare facility at UAB. Our market here in Birmingham and Alabama at large is heavily populated with owner-managed businesses. It is just a key component of our economy. So way more often than not, we will have a new client that will come in that's either had an owner-managed business in the past or they've got one now. So we look at a lot of different types of consulting objectives with those. And one of those, and probably looking at it the most common, not probably it is, the most common is working with the debt or loan financing of that business. We've got some specialized expertise in our firm with that. In the two of us within our firm, our CEO, Greg Powell, and myself, early in our careers were commercial lenders at large banks here in Birmingham, and we were involved in this. So we're trying to pay that knowledge forward for our clients here at Five Plan, and we enjoy doing that. So first, let's talk with about three kind of rules or myths, just in general, or roadmap things in SBA lending. The first thing you always need to do, if you're interested in doing a small business administration loan, check the SBA website. That will give you anything that might be a new rule, a change. Remember that the SBA is a government legislative animal subject to Congress, so they can make rule changes from time to time. Over my many years of dealing with SBA, there hadn't been a ton of changes. The core of the program is still the same, but there are changes that come up from time to time you need to check. The best example of that I can think of is that early in my career, you couldn't, for example, really use a 7A loan to help acquire a company. After 2008, that rule changed and you could. So the first thing, as much experience I have with these, I always do, is I will check the SBA website to see what's new and improved, so to speak. The worst thing you can do is go down a trail and work on one of these, and you put a lot of time and money into it and realize that the rule has changed on what you were trying to do. So first rule is, in the general playing field, always check the SBA website for what is the most recent. That's first. Secondly, there's a myth out there that SBA loans can only be used for fledgling companies or marginal companies or distressed companies. Get that myth out of your head. Nothing can be farther than the truth. Over my many years of working with Five Plan clients and banking other non-Five Plan clients before, most of the companies that I did SBA loans for were extremely strong, very credit worthy. I would have done the debt placement to them without the SBA behind it. But the reason we did it, there were certain features of SBA loans, mainly longer term, less down payment in. You could finance soft cost like architectural engineering. There were some advantages of SBA lending in the structure that many times my strongest clients use. So that's second. It's not just for a company that's in trouble. I think that's a myth out there that's just incorrect. Third, there's a lot of discussion. I hear it all the time from clients of ours. They say, actually, I don't want to go that way. The paperwork's too involved and this and that and the other. Don't be discouraged by that. Back in the 1990s, there was some truth to that. The paperwork process and SBA loans could kind of beat you to death back in that day. And I would somewhat agree with that. Over the years since then, the SBA has, number one, really streamlined that process. That's first. Secondly, we have very good friends here in Birmingham that are experts in packaging SBA loans for companies. And that's the other complaint you'll hear a lot of our CEOs say, look, we need to do it. I just don't have time to fool with it. And we're like, that's not a problem. Let us call one of our associates here. And what they could do is they can sort of take the paperwork burden over and you can still run your business. So there are firms out there that we work with a lot that can do that, that now that SBA has streamlined the process, it's even better because you could just pay companies to help you do that. As an asterisk right there, I will say probably most people's experience recently with the SBA is through the PPP process back in COVID. And that kind of got some negative implications for it, but it was nothing the SBA on the SBA side is the fact that during PPP, we just hit it with so much volume at one time. And I don't care what the process or system is. If you hit it with too much volume, it can overwhelm it. So we're not talking about the unique ecosystem today that was the PPP process. We're just talking about SBA lending in a normal environment. So, one of the first questions I heard years ago from a bank customer of mine is actually what qualifies as a small business? What's the definition? So let's start there. A Fortune 500 company, it cannot get an SBA loan. That's not what this is designed for. The SBA is designed to accelerate employment in the United States in the small business sector. That's where most of our job growth in the United States is anyway, and the SBA is designed to enhance that. So the three main things generally that qualify you for a small business and thus eligible for an SBA loan, one is, seems obvious, you have to be in the United States or one of its possessions. This is not for anything foreign, even by American ownership, because again, a lot of the objective is to enhance employment in the United States. So you got to be a U.S. company. Secondly, your tangible net worth in general needs to be 15 million or less, 15 million or less. And then finally, your earnings over the last 2 years before you apply for an SBA loan need to average about 5 million in net income or below. So you can see the SBA kind of qualifies that to a U.S. company. And as the name would suggest, those that are a little bit smaller. So that's first part of it, give you some good general anecdotal information. Again, check the website, and that's what you have to be a small business. So what Brian's going to put on the screen for you are the two major SBA type of loan vehicles for a business you usually see. But let's start with a 7A loan first. First of all, a 7A loan, you can get up to 5 million. That's first. That's sort of the cap of the amount SBA does. Secondly, the 7A, not exclusively, but the 7A loan process is mostly used for working capital lines of credit and to finance equipment, generally shorter term loans that are more in the production cycle within the company, either working capital or new equipment that they use. Now, how the loan works, when I was a banker, what would happen is a company would come in. I would do the loan, the SBA loan, with the client. And the way that that worked is that the terms on of the loans within SBA parameters were kind of up to us. What I would do is I would actually do the loan. The 7A loan works where the SBA would come in and do a guarantee of a certain amount of the loan kind of underneath me to give me more confidence to make it. If you have a smaller loan up to about 150,000, they will guarantee up to 85% of that. If you have a loan amount that's over 150,000 or between 150,000 and 5 million, they'll guarantee 75% of that. So when I was working with a customer, the bank would actually grant the loan. The SBA would come in behind me with a guarantee on the loan. I would negotiate the interest rate and the term of the loan. The only thing that I couldn't do on the loan interest rate is to exceed the SBA maximum. But what I could usually do with a 7A loan, where let's say for a normal equipment loan it would be 4, 5, 6 years, you could extend the term out to 10 years. Now, many times a 7A loan too, it was not an either or in many cases. You could do working capital or you could do term debt. A lot of times the clients I would have in doing that did a little bit of both. They had part of the loan that was working capital line of credit. Maybe they had landed a large new customer that they needed to finance the trade cycle with. And then maybe they needed a new machine also within their fixed assets to produce the work. So most of the time, probably really was most of the time when I did a 7A loan, you'd have some combination of part of it being working capital and part of it being term debt. The safety net as a banker always had, or with our clients here at Five Plan, is it would give the bank extra confidence on the quality of the loan for whatever reason. And so that was a very good way to use that. Again, some of my strongest clients would use that both here at Five Plan or in my banking days. And the main reason many times they use the 7A, get a longer loan term. The cash flow that they would have to cover on the loan payment was their shoe was not as tight. They could handle the cash flow on it because if they were doing equipment, they could go out to 10 years in financing, where a traditional bank loan was half of that. So the monthly cash flow demand of paying the loan was just less. It was just easier to do. One sort of redacted example I'll give you, a 7A loan, and kind of how that works. This was back in the 90s, years ago. I had a customer here in Birmingham. And what the company did is if you walk into a grocery store, a convenience store, they would do these point of sale displays in stores around soft drinks. And the largest client they had was one of the two larger soft drink manufacturers. And they would do that type of work east of Mississippi River. And so what this company did was they would, remember this 35 years ago, so they would print these point of sale displays on this machinery. And back in the day, it was black and white only. There was no color. Well, the CEO and the CFO of that company came to me, and they were very smart strategically and tactically in the amount of loan that they wanted. I would have done traditionally anyway. It was a strong company here in Birmingham, not large, fit within the small business administration guideline category. But their CEO told me, they said, we're beginning to get some demands from our largest customer that they really want to start doing these point of sales in color, not in black and white. So what we did for that company is we used a 7A loan to finance about a 750,000, I think was the range, equipment of a long printing machine that was computerized for color. Well, what happened is the company, because of that, just exploded, being able to use that capability. Not only did they hold on to their major client, but they got a lot more clients east of the Mississippi River, simply put, because the capability was more. But at the time, that loan was a large one for that company. And as a small to medium-sized bank, it was a pretty large loan for us. So using the 7A process helped them and helped us. It helped them by having a loan amount on that equipment that was 10 years in payback rather than the normal 4 to 5. And it helped us because it gave us more confidence that we, as the lender, had more protection behind that. So that was just an excellent use of a 7A loan. In that particular case, they already had a working capital line that was working well. They didn't need to increase it. They just used that 7A loan for the equipment. But that one piece of equipment, it was large, but that one piece of equipment just revolutionized the future of that company. But it ended up being a great loan for us at the bank that was safe because with that loan size, I had a 75% loan guarantee as a banker, and it gave them more relief on the cash flow. So that was a perfect way to use a 7A. So again, your 7A is usually working capital or term debt within the normal operations of the company. Now, the second loan type that Brian's going to put up for you is the 504 loan. That's mostly used for commercial real estate financing or improvement. 504 is kind of a numerical acronym that stands for 50% of the proceeds of the loan or the bank, 40% of the loan proceeds or the SBA, and 10% of the loan proceeds come in from the borrower. So in that particular case, anytime we have an SBA loan here that's a 504 for a client here, or in my history that I've financed back in banking days, what that allowed me to do is once again do more for the customer. At the same time, there was more cash flow for relief for them, so it was great both ways. In that particular case, it was a little bit different. Remember, in the 7A loan, I did all the loan proceeds. I just had the SBA guarantee up behind it. Technically and legally, it's a little bit different in that a 504 loan, again, 50% is done by the bank, 40% is actually funded by the SBA in the open market. So the bank would take a first mortgage, the SBA would take a second mortgage, and the borrower would put 10% in. The advantage of a 504 loan, and again, most of the clients we've had here at Five Plan or back in my banking days, most of my 504 clients, they could have gotten a traditional bank loan anyway. But where the traditional amortization on that commercial real estate loan was 15 or 20 years, the SBA allows you to go out to 25. If you've got a large loan, that's a huge difference. You can get up to 5.5 million, a little higher on a 504 because it's on real estate, sort of makes sense. You know, those are usually the larger purchases. So SBA has set that ceiling a little bit higher. But what I mostly saw with that is that the clients either here that we use, what they used a 504 loan is it just sort of gave them more cash flow relief. And again, as a banker and also here at Five Plan, it gives our banks that we help our clients deal with here, it gives the bank more confident that they've got the entire loan on their books, but 40% is in the way of a second mortgage, the SBA. Again, like the 7A for the bank, it's safer. And for the client, it's better because you can do so much. Under a 504, there were really three advantages I usually saw and see here with clients using it. Number one, they have to put less money down on the loan, where it's normally 20%. Using a 504, it's just 10%. So you can save you cash, first of all. Secondly, we've already mentioned that the amortization can be longer with a 504 loan, which lowers your monthly payment. Where I saw a 504 used a lot is there are many soft costs like architectural, engineering, things like that. The SBA allows you to roll in a lot of the soft costs that you have on the front end with doing the project that a traditional bank loan in terms of the loan to value and the collateral won't allow. So you can throw a lot more expenses on the project in there. So the example I'll give you of that one is a client also in the Birmingham area. They were in a commercial building they leased. They were a large HVAC contractor, very well known in the Birmingham area, but they were leasing the space. Well, what they wanted to do is build their own building, and they were going to do that. Again, this is a very good senior management group. They were going to do that in two phases. They were going to do a first phase and a second phase later. Well, what we were able to do with a 504 loan, because the amortization was much friendlier and we could put a lot more soft cost in, what we were able to do is do both phases at once. So they were able to go and do a construction perm loan using a 504 and they did not have to wait for the second phase. We were able to do all of it at one time. And once again, that gave that company a lot of capability with customers that they were going to have to wait on. So those are your two examples, main examples of SBA loans 7A and 504. Let me close by saying we have a lot of experience with those here in helping our clients do that. Feel free to call me personally if you need a little extra help on that or a little extra guidance on that. You can reach out to us in any social media platform, or as we always close our videos and say, we're just friendly Southerners around here. So we enjoy when you just drop by to see us. So we hope this has been a little bit familiar with giving you a few just rules of the road and a little bit more of the highlights of the two major SBA loans that most companies use, but it's not exclusive. So if you need to know more, just let us know. Other than that, I hope you have a great rest of the day. Thank you.